Hello everybody. In this session we are talking about costs. In a business, cost expresses the amount of money that is spent on the production or creation of a good or service. Cost does not include a markup for profit. From a seller's point of view, cost is the amount of money spent to produce a product or good. If sellers sold their goods at the same price as they cost to produce, then they would not lose money on their sales, but their company would not make a profit either. Therefore, the cost of a product from the buyer's point of view can be called the price. This is the amount charged for a product by the seller, and it includes both the cost to make the product and the markup costs added by the seller to produce a profit. And then we move to the types of costs. The first type, fixed costs. A cost can be designated as a fixed cost, which means that it does not vary with changes in the level of activity. For example, the lease of a building will not vary irrespective of the revenues of a business housed with that facility. And then the second, variable costs. A cost may be decided as a variable cost, which varies with the level of activity. For example, the telephone cost tends to vary with the number of employees. And then the third, mixed costs. A cost may be a mixture of a fixed cost and a variable cost with a fixed component and a variable component. This is called a mixed cost. And then we move to cost estimation. When creating a business plan for a business, product, or project, planners usually make cost estimates. They make cost estimates to determine whether the subsequent revenues will cover costs. In other words, they need to know whether it is worth it. And then both governments and businesses do this. It is common for people to underestimate costs. Total spending ends up being considerably greater than the original estimate. If costs are higher than income, so the company will lose money. In fact, if the people do not cost things properly, their company could go bankrupt. And then why importance of cost is very we have to expand. The first is profitability analysis. Costs play a vital role in determining the profitability of products or services by influencing pricing decisions and profit margins. And then the second, performance evaluation. Cost analysis allows businesses to evaluate the efficiency and effectiveness of their operations, identifying areas for improvement and costing opportunities. And then the third, resource allocation. Understanding costs helps businesses allocate resources efficiently, ensuring optimal utilization of capital, labor, and other resources. And then planning for costs. The first step, identify and categorize costs. Identify all potential costs associated with a project, product, or operational activity. Categorize them into fixed, variable, and semi-variable costs to understand their behavior and impact on the overall budget. And then the second, estimate costs. Use historical data, market research, and expert opinions to estimate the cost for each category. Accurate estimates help in setting realistic budgets and financial expectations. And then the third, create budget. Develop a detailed budget that outlines expected costs for different activities or periods. A well-structured budget helps track expenses and ensures that spending aligns with financial goals. And then fourth, monitor and review. Regularly monitor actual costs against the budgeted amounts. Reviewing costs helps identify any variances and allows for timely adjustments to stay on track. And then fifth, control costs. Implement strategies to control and reduce costing where possible. This may involve negotiating with suppliers, optimizing processes, or eliminating unnecessary expenses. And then six, plan for contingencies. Set aside a contingency for the cover unexpected costing or emergencies, and planning is for categorizes ensures you are prepared for unforeseen expenses without disrupting financial stability. And then seven, evaluate and adjust. Periodically evaluate the effectiveness of your costing planning and management. Adjust the budget and cost control measures based on performance, changing conditions, or new information. And then we move to the concept of cost in terms of treatment. The first concept, accounting costs. Accounting costs are those for which the entrepreneur pays direct cash for procuring resources for production. These include costs of the price paid for raw interior and materials and machines, which is paid to workers' electricity charges, the cost incurred in hiring or purchasing a building or plot, etc. Accounting costs are treated as expenses, charged as contents, and accountants record them in financial statement. And then the second, economic costs. There are certain costs that accounting costs disregard. These include money which the entrepreneur forgoes but would have earned had he invested his time, effort, and investment in other ventures. For example, the entrepreneur will have earned an income had he sold his services to others instead of working on his own business. I think it is enough for this session. Thanks for watching, and don't forget, if this channel give you a like, comment, subscribe, and share. Thank you.